Well, the United States of America is the world's largest economy, and it's also home to 40% of the globe's investable assets.
Right, so what is typically tracked when you talk about that market is the S&P 500. We know what that is. It's a index of the top stocks weighted by their capitalization. So clearly companies like Apple and so on at the top end of the list are going to have the biggest influence, although it is a big and powerful group of stocks, and all of them at the top end have international operations.
Mia, let's start right here. And is this set to be the biggest beneficiary of the current global environment, taking into account both Greece and China?
Well, what I like about this sector is the fact that it gives you exposure to many multinational companies. So you're not actually just getting exposure to the US, you're getting exposure to markets that are growing. So companies that are positioned very well, companies that have grown to be the biggest in the US and listed there, but have sort of operations all over the show. And they have to report back into dollar, which hasn't been such a positive for them over the last couple of quarters. But over the longer term, we need to look through that and look at where they actually do business and how well they're faring there. And they're faring pretty well. So we're excited about this. When we look at the US, we think that, it's a solid sort of growth story. There's solid fundamentals that's driving the growth that we've been seeing from the US. And we don't have the same sort of wonky dynamics that we're seeing in Europe at this moment, so more stability there.
Well, we don't want those wonky dynamics, Paul, for sure. You've got to be a big believer in the US, and specifically the likes of Johnson & Johnson, Apple, Walmart that you mentioned earlier.
Well, look, talking about that market is very well spread out. We know that technology is a big and important chunk of that market with global titans like Apple and others. We know that healthcare is very big there. So you mentioned Johnson & Johnson, but there are also all those second-tier players like Pfizer and associated healthcare companies in the medical diagnostics and equipment area. There's a huge financial footprint. So you've got the JP Morgans and the Wells Fargos and the Citibanks of the world, and then also huge retailers. So Walmart and Costco and those sort of people. And you haven't even begun to talk about mining and exploration companies, the big oil majors. So the takeaway here, very diversified. As Mia says, lots of international operation. So I really think this is kind of the alpha market to go to. The question really is, does it make sense to buy this one chunk and then build that into your portfolio? Or should you not try to get money offshore and go into individual stocks? That's more normally been my procedure. But Mia made some pretty good arguments for why smaller investors.
And a rumbling from Mia as you put forward that thesis.
Yes, I think, I absolutely agree with Paul. If you have enough money to make it financially viable to go offshore directly and invest in these great companies where you can be more selective in what you want exposure to, that's the first prize. But if you don't have enough money, or you are, you have a trust and there's money in the trust that can't invest offshore, then these are great ways to increase your exposure to foreign markets and actually diversify yourself against the rand.
But wait, I want to put out a question now because I'm surprised you haven't done, so I'm going to do your job for you momentarily. Isn't the US market ludicrously overvalued because of all the cheap money from the Fed? And aren't the Fed about to raise interest rates, at which point the entire US market is going to go into a downfall and collapse on us later this year?
Well, there's speculation, Mia, that interest rates will rise as early as September. Answer Paul's question as he puts it, doing my job.
Well, that's true, but if I can just remind you, you've been taking a longer term view since you've been moving the portfolio. And when you consider that, and you're an investor that's starting maybe to invest on a monthly basis and contributing on a regular basis, then you shouldn't be trying to time the market. If you want to be invested in equities, you're anyway going to do it for the longer term. And if I'm talking about long term, I'm talking about 10 years or longer. And then you're not going to feel the effects of those sort of downturns, even significant downturns like the 40% drop we saw in the market, 40-50%, 2008, 2009, has been, recovered if you take on a total return stance in 3 years or less. So, you shouldn't be too worried about those sort of movements. Rather buy the whatever you are buying, in this case the ETF, for the value of the companies underlying. And those value is not driven necessarily by the price and market sentiment, but more by the earnings growth of these companies.
Are we going hot or not on the US, Paul?
Look, I'm comfortable with the equity market valuations there. I'm not anxious about the Fed. I'm thinking that the Fed's moves are going to be so calm and measured and late that we're going to continue to see good growth from that market. I think the whole currency thing with the dollar being so strong is probably going to moderate a little bit. So I definitely think you do want to be there. The question, I guess, and we'll address this later in the show where we talk investment of the day, is whether this is the right strategy to go and put this kind of exposure into the portfolio. But I'm definitely hot on it. Definitely hot.
Europe, hot or not?
I'm
Sorry.
also hot on it.